Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the dollar couldn't absorb the resistance near 88 and 90, sold down to the 78 support. This is what we said in July. The Federal Reserve policy quantitative easing was cited as the reason for the shift in the sentiment toward the dollar. If the dollar absorbs the buy orders at 78, it will retest the next support level near 75. And that would become, 78 would become an area where there'd be some resistance. So this is how we usually plan our trades out. We don't know what's going to happen. We don't know if the buyers are going to win the contest or the sellers are. And as it turned out, of course, quantitative easing, our economy has caused just about an entire retracement because this is actually called printing money, which, of course, everybody is afraid is going to lead to some kind of a period of hyperinflation. And folks, you know it as well as I do. You could turn on the TV right now and every other word out of everybody on the TV on a financial channel is dollar. And as a matter of fact, Dennis Gartman, who writes the Gartman letter, he was on one of the CNBC shows the other day, and he said he was actually riding in a taxi cab with a couple of older women, and they were talking about the dollar. So yours truly has had those same kind of experiences riding in taxi cabs with people talking about the bonds back at the top of that market last year. So our sentiment going forward here in October is everybody in the world is bearish on the dollar. The UN has downgraded the dollar. Moody's has threatened to cut our AAA credit rating. This is usually a contrarian indicator. Unfortunately, the official policy of the Federal Reserve may be to allow the dollar to depreciate in order to repay our trade deficit with cheaper dollars. So in other words, if they let the dollar fall another 50%, they can repay that big trade deficit with cheap money. That could be the unofficial policy. And like we said, just like this last slide says here, all this printing of money is leading to the inflation of asset bubbles. They would love to reinflate the real estate bubble, but unfortunately, unless it's controlled, it could lead to a period of hyperinflation. All right. So since the dollar futures is near the origin of the rally from last year, which is support, potential support, there could be a nice strong counter-trend short covering rally. The volatility index, the VIX, is also near yearly lows, indicating not too much fear in the equities market. And another old saying is the market likes to catch as many people on the wrong side as it can. So the liquidity-driven equities rallies could lead to some kind of an explosive blow-off top situation. And believe me, guys, I'm not saying that that's what's going to happen. I'm only saying that I've seen it, and it could happen. And if it does, the market will top out on a weekly chart and drop. And if that happens, then we'll begin shorting the market again because on the high time frame charts, we'll know that we probably have some kind of at least temporary blow-off top. As I mentioned before, not every person is going to be suited for this type of range-bound trading. A position trader is certainly not going to, spend his time looking at charts, looking for the opportunities. They just buy and they hang on and draw their trend lines, and they can hang on as long as they want, and that's fine. That's their personality. That's their trading style. Trading ranges can be boring, no question. Watching prices go nowhere for long periods of time. Trend traders will always do this. This is where they lose most of their money. Unless prices are actually trending, a trend trader is always shorting a top or buying a bottom. Shorting a bottom or buying a top. And as long as price stays inside that channel, they get eaten alive with whipsaws. Okay? So you should be able to identify the trading ranges. Hopefully, after my presentation today, you'll kind of keep an eye on those high time frame charts just to see what the market's doing. And if you see that we're basing and going sideways in a channel, now you'll have a few strategies when we're finished here that you can take advantage of that with. So what I like to do is select currency pairs that have past support areas for potential future trading range bottoms. In other words, I look for the origin of big rallies and big declines from the past, and then I project that when price revisits those levels, there'll probably be willing buyers in near support levels and willing sellers near supply or resistance. Okay, and remember, all of what I'm saying to you comes from me actually learning what I learned firsthand from somebody who handled the institutional order flow in the Chicago Mercantile Exchange. And he would understand that when prices were trading, if he had a big stack of sell orders sitting on his desk at a certain price, like 95 cents in the Japanese yen, until every one of those sell orders was filled, prices were not going to go much further. So this is how we educate our students, especially in the extended learning program. This is the focus of the main strategy. And we teach you how to find these areas on the chart by looking for these areas in the past. And really, what else is a chart really good for? What's an EKG good for? Looking to see what happened in the past so that we can predict what's probably going to happen in the future. Okay. So now we're going to locate a nearby resistance area. Once we find our bottom of the trading range, we'll find our potential top. And understand right away that you are trading, when you're trading that channel, you're going to be trading the intermediate term trend, which is going to be counter to the primary trend. So in other words, if the channel is very, very near the origin of last year's rally, I'm going to be more comfortable that we may be finding high time frame support. However, if one of these channels happens anywhere between the origin of the rally and the potential top, then I'm probably going to take profits more quickly because that trade could break out to the downside and continue lower. The other thing is, again, with options, once you understand the different strategies, if you think you're in a downtrend, just do a ratio to where you've got more puts to calls, hang on to the puts. And if the trend does continue lower and you've bought enough time, you're in great shape. You can hang on to that trade and still trade an option strategy as a trending strategy even after it breaks out of that range. And remember that volatility is going to be very, very important to determine which type of the option strategies that you're going to trade. Okay? The reason I say that is a low volatility trading range down here is much different than a high volatility trading range up here. Okay? So again, your options are going to be much, much more expensive here. The ones you sell are going to be more expensive. And so your strategies are going to be different because of the higher volatility. This is actually a chart from February of the dollar versus the Australian dollar. And remember, we had that stage one accumulation, and then of course we had the big breakout when the dollar, the flight to safety trade. And then of course we got to a point where we were up at 165. Notice here how the bottom of the trading range originally, let me get a different color here so you can see what I'm talking about. The bottom of this trading range originally was a little bit higher up, closer to 142. Be nice if I could find the white one. Maybe gray? Nope. All right, anyway, where the pencil's pointing here, about 145. We originally started trading in a smaller trading range, and then we had what we call range extension. We actually extended the bottom of the trading range before we actually rallied again. Notice here we actually extended the top of the trading range a few times before we actually started to top out. So this trading range here can be a living, breathing thing, and you have to get used to seeing these a few times. But usually accumulations are very, very quiet, and distributions are wild affairs like you're seeing up here. In other words, the institutions like to buy low, and then of course the public, once they see what's going on, they're the ones that cause the high volatility in these trading ranges. So it's just good to know why you see these volatile ranges like this.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.